market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, let's start with Nvidia, which has suffered a record single-day rout. The company saw almost $280 billion wiped off its market value during yesterday's trading session. That's the biggest one-day loss in U.S. stock market history, on worries that the AI boom has been overdone. Now, the sell-off continued in Asia. It's left investors in Europe unsettled as well, with all of Europe's main markets in the red this morning. Now, we're joined by Patrick Armstrong, Chief Investment Officer of Plurimi Wealth, and our anchor, of course, and tech expert, Tom McKenzie. Tom, thank you for joining us. Patrick, we called you as soon as we saw the sell-off because you understand you're also, into single stocks. What happened here exactly?
And that's a very good question without a very clear answer. It's like a flock of birds. It's just one of them startled and then they're all flying off. And the PMI number was weaker than expected, but marginally. Prices in the PMI survey were a little bit higher than expected. That doesn't dampen the Fed's cutting potential. So I do think it's profit-taking and a little bit of investors just creating some selling momentum that's self-fulfilling. So I don't think there's anything really fundamental behind the sell-off other than technical factors.
So technical factors, but also, Tom, it kind of got sparked by this antitrust concern. What is that?
Yeah, so there's a couple of things coming to play. And as Patrick was saying, look, the market seems to be primed for a bit of profit taking. And then you get a couple of analysts coming out. Before we got the Bloomberg reporting on this DOJ probe, a couple of analysts coming out, including from JP Morgan and BlackRock, warning again about the return on investment for companies like Nvidia and saying, look, if you're getting these hyperscalers like Microsoft of the world and Amazons of the world spending so heavily on CapEx, you do need to see the services end, so businesses outside of the world of tech starting to show that there are some payoffs then and that they're getting involved in AI. And so far, that's not happening. And so BlackRock as well saying, look, there's going to be patience. This is not going to be a question of months in terms of ROA on these investments, but years. And then you had the exclusive reporting from our team led by Ian King in San Francisco on this DOJ probe. So they've gone from asking questionnaires, informal questionnaires being sent to Nvidia to get a bit more information, to official requests, legally binding requests, and Nvidia will have to provide that information now because antitrust regulators in the US are concerned about the role that Nvidia has within this Gen AI space and whether or not they are squeezing out other competitors and leaving their customers tied into their ecosystem and not having the ability to look at other competitors in terms of options.
I mean, good reasons to worry, but again, it probably doesn't justify a one-day single move of $290 billion being wiped off.
It doesn't. The stock's still up over 100% year to date, though, so there are people who are crystallizing profits as they see some risks emerging.
Is this in a bubble? I mean, one of the things that we were talking also with Tom is that when you look at the earnings from Nvidia, I mean, they did very well, and yet people were disappointed with the margins.
I don't know how you can be disappointed with those margins because those margins are unsustainable. Eventually, there's going to be competition that are going to push those margins down. But that's why I'm not worried about the DOJ, is that Nvidia's competitive advantage in squeezing out competitors are the processing power of its chips. And it's not doing anything illegal. It's just producing a better product. And that's what's driving its revenue. And that's what's leading to the profit margins it can generate.
Tom, are we expecting anything from Nvidia today? Do they come out with statements, or does it just have to run its course?
Yeah, so look, they've pushed back on this. They said the reason that we have this market share, and they have, about 90% market share when it comes to these AI-assisted chips, these GPUs, these AI accelerators, is because our products are just that much better, and our customers are very pleased with our products and our services. But kind of to Patrick's point, it's also the DOJ probe is also a reminder, or at least information gathering, is also a reminder that this is not just a company that produces the chips. It has that whole ecosystem that is proving so attractive to its customers. It has the servers, it has the software, as well as those GPUs. It packages that all together very successfully, and that is very compelling to its customers. And again, these probes, if we get to a point where this is actually an official probe rather than just official and legally binding information gathering from the DOJ, we know history tells us this takes a long time to play out.
Yeah, I mean, again, the concern is, so there's a subpoena, there's a DOJ, but at the same time, there was this weak manufacturing data. Yeah. And so I don't know how much that played into thinking, well, look, if there's manufacturing data, we see a recession, we see a slowdown in the U.S., that's definitely going to impact some of these stocks.
The bull market is predicated on an economy that doesn't fall into a recession and a Fed that's cutting into that relative strength from the economy. So any indicators that show a recession is becoming more likely or plausible is going to spook the markets. I think it was a very minor miss. Our base case is the economy continues probably sub-trend growth for the next few quarters, but does avoid that recession.
So John Authers, one of my favorite, actually, writers, Bloomberg opinion writers, wrote in his column today, "Wake me up when September ends." I mean, it was a pretty difficult start to September. Is it going to be bumpy for the whole month?
Traditionally is. You get a volatile September and a rally into year-end. That's quite often the path. The jobs number is going to be very important, and that'll guide us whether recession is going to become a base case, because you've never seen a jump up in unemployment like we've had without having a recession, but you've never really come off a base of unemployment being so low before. So that's why I'm still constructive on the economy. Recession's plausible. Don't think it should be the base case. And I do think a cutting Fed, an economy that's not in recession, you want to be in that market that's grinding higher.
Tom, there was definitely a risk-off mood, and I guess the sell-off spread to some of the Asian markets.
Yeah.
You know, the regions, for example, technology, semiconductor, supply chain companies were down, but maybe not as much as they could have been.
Yeah, one of the biggest losers in the European session right now is ASML, of course, taking a big hit. And tech, the last time I checked, was the sector taking the largest hit as well, down the last time I checked about 2%. But as you say, of course, there's a smaller mix of these big tech names within the European space. Yeah. And to your point around what happened in Asia, yes, that was the trigger for the sell-off, particularly in Japan and South Korea and Taiwan. TSMC, of course, prominent amongst those names that saw pressure as a result of the concerns that filtered through around Nvidia yesterday. So it has global ramifications, and we're seeing that. But again, to your point, less extreme here in Europe because of the concentration mix that is less potent when it comes to these tech names.
Tom, thank you so much. Tom McKenzie there, of course, our anchor for Daybreak, and our tech expert, Patrick Armstrong from Plurimi, stays with us. Now, coming up, more analysis on the global sell-off. We'll also be joined by Yuko Takano from Pictet Asset Management for a deep dive into what all of this means for equities. This is next, and this is Bloomberg. Welcome back, everyone. It's definitely big markets day. We're back with Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, and Yuko Takano, Senior Equities Investment Manager at Pictet Asset Management. Thank you both for either sticking around or joining us. Yuko, what a day. I mean, we've seen a huge sell-off. And again, the underlying reason is not obvious. So is it a buying opportunity, or are you staying away?
I do think that these, we had this weakness back in end of July, early August, right? And I think it's back again. And I think markets are really nervous because we're really caught in this rut of, if the economy is weak, that's really bad for markets. But the markets also desperately want some kind of a rate cut. So investors can't have their cake and eat it. And so they're in this state of confusion. And that's why we see a ton of activity going on in the market.
I mean, are there, sectors in equities that look more attractive? We're trying to figure out whether this is a bubble or whether we're just going to see this bouts of volatility when investors panic.
I think that we will continue to see this type of uncertainty in the market for a while. I can't say exactly how long, but any type of economic figure like the ISM yesterday or the jobs number on Friday that comes out, that could always lead to volatility. As long-term investors, we invest on a 3 to 5 year horizon. So we're not really bothered by that volatility. Instead, we have, we redo our valuations, we've diversified our portfolio, and we really look for opportunities to invest in these types of markets. They create really good opportunities.
Are you looking at anything specific at the moment, or does it have to kind of play out in the next couple of months?
I think we want to see how it does play out. But having said that, if a particular stock looks really attractive, then we'll go in. So it's really about that gap between what we perceive as their true value or their intrinsic value and where the market sees it.
Patrick, are you buying anything right now, or are there opportunities out there?
There's definitely opportunities out there. Overwhelmingly, the market's expensive, but there are opportunities. We bought Roche a couple of weeks ago. We sold Novo Nordisk. Novo Nordisk, very expensive. It's got the obesity drug that everyone's after, but Roche is showing great potential in its obesity drugs. We bought DR Horton. With the Fed cutting rates, we think house building is going to get a tailwind in the U.S. That's a cheap company. 3E, Dassault Aviation, we think military spending is going to continue. That's a secular tailwind. So I do think the market's expensive, But I do think if you are picking up companies that have growth potential and are trading below market multiples, that's a winning strategy right now.
The market is expensive because we're also maybe underestimating the impact that, weak China manufacturing data has. Or, I mean, there seems to be, I can't see anything that you think, oh, this is going to go right. Everything's slightly tilted on the negative side.
Yeah, China is something I'm definitely worried about. We're shorting Kering, luxury plays right now, and we moved into Walmart last month. I do think the U.S. consumer is very strong. I think the luxury high-end China consumer is going to continue to be at risk. All the companies I just mentioned, I'm very optimistic on the outlooks of those companies. Our bullish, relatively bullish scenario is based on an economy that's growing and a Fed that's cutting. About having your cake and eating it too. I do think the Fed's rate is so high, you can get cuts even with economic growth because the policy is restrictive. Inflation has come down. The Fed can be cutting even with economic growth, in our opinion.
Yuko, how do you see? I mean, of course, the Fed is the big one. It's the one that kind of changes everything. It could be a buying opportunity, but the China macro is also something that markets were expecting, some kind of bazooka that we never had from policymakers.
I mean, I think that, even with the stimulus, that's kind of more like a manufactured growth, right? So what we're really looking for in China, although we're not really exposed to China at all, is that kind of more fundamental strength in the economy. And I think with China's PMI being really weak and the consumer not being very confident, I mean, this, I think, all links back to the issues that they're having in the real estate sector. So until those issues are fundamentally resolved or there's some kind of glimmer of hope, then, we're just going to sit back and wait.
But a lot resides on that jobs number on Friday. Are we expecting too much from it?
The market's definitely going to be fixated on it. I think the unemployment number, rather than the jobs number, may be the thing that really matters. If you do see unemployment go up to 4.5, maybe I will change my view and think that a recession is becoming a more likely scenario. So I think it's a very important jobs number because it's leading into the Fed, and a couple of weeks after that, it'll be something the Fed will really be looking at as well.
And so there's like a before jobs data, positioning and an after jobs data positioning.
Sure. But within our portfolio, we're pretty defensively positioned. We're we're long on consumer staples and utilities, and that's helped us throughout this whole market turmoil. And then in terms of the pockets of growth, we do think that within tech, there have been companies where multiples have come off quite a bit. We want to see if there's any other opportunities in that space.
We're 16 minutes into the show, and we haven't even mentioned yen. And what is going on? How much of the unwinding still has to happen of the carry trade?
It's very difficult to say the answer to that. That was the driver of the early August sell-off. It played out a little bit yesterday as well. I think investors who had big positions on, those are closed now. So I don't think that's a catalyst at this point. It's probably still there to some extent, similarly in Swiss franc, but I don't think that's going to be a driver of volatility the way it was.
But you're expecting, I guess, aftershocks.
I think there will be aftershocks, but whether that's going to be due to the carry trade is a little bit uncertain because, we're really not sure to the extent how much has been unwound or not.
Yesterday, some of the moves, again, so Nvidia, we spoke, at length about that, but the oil has also dropped to a low for the year. How much of that is, some of the technicals, mechanics, and how much is it geopolitics?
Yeah, so oil had a geopolitical risk premium built into it, definitely. And I don't know why that came off the table yesterday a little bit. It was basically economic-driven, weaker PMIs, pricing in a weaker economic backdrop creates the sell-off in oil, but I wouldn't want to be short oil, and there's a big short in oil. And whenever the market's all squeezed one way and that geopolitical shock comes, and there's so many things that could trigger that, and that wouldn't be a short I'd want to have on right now.
Does that also, I guess, feed into your transition play?
In some ways, yes, but I think what we're focused in terms of our transition fund is really on the long term and the transition away from oil. So short-term oil price movements don't impact our performance that much. And we do think that, we say that we're looking for a transition. It's not like, from day to day, it's all of a sudden going to change from 100% oil to no oil. So that's a more gradual, long-term transition that we are invested in.
Does the transition? We have the big U.S. election coming. Yeah. And I think Goldman Sachs had, some of the first modeling of what the presidencies mean for GDP. when's a good time to come in and kind of take some of that into account? The polls are pretty narrow.
It's very close, close to a coin flip still at this point. And yeah, you've got very different policies. You'll have Trump with deregulation, but with tariffs. And you'll have Harris, if she gets in, with more regulation, more spending. Both of them will have massive deficits. And I think that's something that's really going to be a 2025 story is the U.S. deficits and debt. And does populism get you elected, but does it work to drive growth?
All right, a million more questions we need to answer. Thank you both for joining us. Patrick Armstrong from Plurimi Wealth, Yuko Takano from Pictet Asset Management. Now, coming up, oil extends losses after a drop of almost 5% yesterday. We took a look at what's behind that slide from the Middle East. That's next, and this is Bloomberg.
There's a orderly unwind and a disorderly unwind. The Fed cut is expected. You know, if they were to be much greater or something like that, it's probably going to be a very orderly process as we move back to lower risk-free rates of return, or think about the cost of capital holding oil in the financial as well as the physical, where that's going to begin to unwind.
Well, that was Carlyle's Chief Strategy Officer, Jeff Curry. Now, oil is extending declines after a loss of almost 5% yesterday. The possibility of political unrest easing in Libya is shifting focus back to plans to boost production by OPEC+. Let's get more now from Bloomberg's Anthony Di Paola in Dubai. Anthony, thank you for joining us. So what exactly is behind the oil meltdown?
Hi, Francine. Yeah, we saw that start yesterday after we spoke with the Libyan central bank governor, the one who had been deposed and has left the country, is now in Turkey. He was saying that this outage could reach a close. They are working on a solution to the political crisis around control of the central bank that has led one of the two governments in Libya to cut production and exports from the country. That's taken about 500,000 barrels a day off the market. That's given some support to the market, but as soon as those comments came out yesterday that there could be a resolution to that problem, that's what gave that initial spark to bring us even lower more quickly on oil yesterday. Add on to that concerns about demand in China, potential lower manufacturing results from the United States, and that adds some concern about demand there as well too. So those demand issues on top of this additional supply potentially coming back from Libya, as well as OPEC Plus's plan to increase in October, that's all having that kind of snowball effect, Francine.
So, Anthony, we started from a lot of oil forecasters, I think from JP Morgan to Standard Chartered, predicting a rally to $90 a barrel or beyond this year. Are a lot of them now having to change their price forecasts?
Yeah, I mean, a lot of the motivations in the oil market changes. We've seen persistent geopolitical risk that has really failed to break through into consistently higher prices. We've seen those knee-jerk reactions, but because supplies have not been impacted by geopolitical risks here, we haven't seen oil take those legs higher. Instead, we have seen the actual issues, rather than having actual issues around supply from this region, we've seen actual issues around demand. In China, asking for more oil, concern also around the U.S., but we have seen additional supply come out of the United States as well as some other countries in the Americas. So that supply picture is looking to kind of overwhelm that demand. So a lot of those investment banks that you mentioned now are looking at surpluses towards the end of this year and into next year, Francine.
Anthony, thanks so much. Anthony Di Paolo there with the very latest on oil. Now, global flight from risk assets, of course, is continuing today. Up next, an exclusive conversation with the founder of Homeserve. That's next, and this is Bloomberg. Good morning. morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European stocks fall after the worst day on Wall Street since the August meltdown as growth worries fuel a flight from risk. Nvidia falls pre-market after a record rout of worries over AI wiped $279 billion from the chipmaker's value, the biggest one-day loss in U.S. stock market history. Antitrust concerns also linger. Plus, Bloomberg has learned that Cathay Pacific may not be able to put all of its Airbus A350s back into service as quickly as hoped after a parts failure as other airlines carry out checks. Now, we are getting a little bit of M&A news. Blackstone has agreed to acquire AirTrunk in a deal valuing the Australian data center operator at $16.1 billion. That's including debt and capital expenditure for committed projects. Now, this is, of course, Blackstone, the New York-based alternative asset manager, but they're doing this with the Canadian Pension Plan Investment Board. And again, they're buying AirTrunk from Macquarie Group and PSP Investment. This is according to something that actually came out a little bit earlier on. Now, private equity giant Brookfield closed a £4.1 billion deal last year for UK household repair business Homeserve. It was one of the biggest takeover private transactions in the country that year, with Homeserve's founder, Richard Harpin, and his family making close to £500 million from the buyout. Now, his family office growth partner now wants to become one of the most active in the UK and is investing in companies weighed towards the consumer sector. Well, I'm delighted to be joined by Richard Harpin for an exclusive conversation. Richard, thank you so much for joining us. First of all, congratulations on the major windfall that you received from Homeserve deal. I was asking you whether your life had changed. Do you feel different?
No, not at all, because I think it's evolution rather than revolution. One of my 8 secrets. And I've remained as chairman of Homeserve, but freed up some time to really focus on Growth Partner, my family investment firm. And it also means that I've freed up a lot of capital, hundreds of millions of pounds, to back entrepreneurs at an earlier stage in their journey.
And so why do you do it? Is that, and I want to come onto your 8 secrets, which is basically what you've learned over your journey as an entrepreneur with then this very successful sale. But, you know, what makes you now want to continue investing? Is it the thrill of finding, you know, the next big company, or is it to give back?
I've got a real passion for business. And I went to Harvard for 4 days a few years ago to work out what my career objective should be. I came up with 2 words: inspire, breakthrough. And I hope if you went to any of the guys in Homeserve that really made the business happen, they would say, I challenged them, I inspired them, and we achieved more than we ever thought was possible. So I wanted to see whether I could apply that skill to other entrepreneurs and use my money to take a minority investments, large minority investments, and help inspire breakthrough in them. And these are typically businesses that are making between £1 and £5 million of profit. My investment would be between £5 and £20 million to acquire a large minority and really help them to achieve that breakthrough growth. I
love this. This is like money and mentoring. It feels like a new chapter on The Pulse. We're like Dragon's Den, but better. What are the key secrets that you've learned, the 8 things that would have, I guess, transformed your business quicker had you known it 30 years ago?
I think the biggest mistake in early stage businesses is don't go big until you've proved the model. I was lucky in copying somebody else and finding that magic plumbing insurance model that took us to 8.5 million customers and policies with Homeserve, and more growth to come. So don't go big until you've copied, pivoted, found the right model. I think the most difficult of the 8 secrets for other entrepreneurs is hire your replacement. I did it after 8 years. I worked out that I was good at vision and opening doors and growth, but not very good at running the day-to-day business. So one of the messages that I convey to those other entrepreneurs is hire somebody to run the day-to-day so you can then work on the business rather than in the business.
And that's what, from the start? Again, you know, the journey of an entrepreneur when you start, I guess, changes. And so you change as a chief executive
I think
as well.
Not from the start, because you need that entrepreneurial ideas, pivoting, copying, finding the right idea. But it took me 8 years before I hired my chief exec, so I'd recommend doing it sort of after between 3 and 5 years.
Richard, when you meet some founders early stage, can you tell who's going to be successful or not?
I think so, and it's number one, it's backing the individual. So I'm looking for what Jim Collins would call level 5 leaders. That's low ego, they're curious, they want to learn, they're passionate about the business, they're hiring great people that are better than them, and they are passionate about the business rather than their own career. So it's those sorts of people. They're persistent, they're courageous, and they're going to confront the brutal facts.
How do you know if they can cope under pressure? Which I know there's a lot of pressure as a founder, and there are very difficult moments always in any journey.
Yeah, I think there will always be pressure, but a great leader, a great entrepreneur will say, I will achieve growth regardless of the cost of living crisis, Brexit, COVID. They will still make their business grow. So it's seeing that inherent determination that they've got.
What are you investing in right now? I think you found something that you think is a bit of a jewel.
Announcing today our first travel investment, which is Host and Stay. We're backing Dale Smith, a great entrepreneur. We're putting in £10.5 million into his business. He started only a few years ago managing a dozen properties, now up to 1,000. And in parallel with my investment through Growth Partner, he's done 2 buy and build acquisitions. So a portfolio of lets in Norfolk and another one in Brighton.
So it's interesting because this is not disrupted. This is not it's an industry that's already been disrupted quite a lot. So you're not necessarily looking for the disruptor. You're just maybe looking for someone with the perfection in execution.
Yeah, and a slightly different model. So the staycation market in the UK is worth about £2.5 billion. Yeah. Dale's got a great model of making sure that the handover between individual holiday lets, we employ all our own cleaners. And that's a really important part of delivering great customer service standards.
What's your take on the UK right now, UK PLC, what the new government will put in place, and whether that spurs and actually spurs a lot of growth in entrepreneurism?
Yeah, my philosophy is whoever the government is, the responsibility belongs to entrepreneurs and to the business community to achieve growth. We only have 7,500 large companies in the UK like Homeserve. They employ 39% of the working population, 53% of the exports. So we just need to double the number of large companies for economic growth. That's going to come out of the forgotten medium, and Growth Partner is investing in those. We're also looking for co-investors. Yeah. So other entrepreneurs that have made it big, that have got some capital, got some real expertise, that want to come in and chair one of our investments and put in a bit of co-investment. So that's a great part of the model.
What's your dream for some of these companies? Is it being a FTSE 100 company? Is it rivaling some of the big US companies that seem to be better at becoming bigger, faster and richer?
Yeah, I think it's follow my 8 secrets and you can build £1 billion business. And do you know how many £1 billion businesses there are in the UK today, with the founder still involved in some way, that was a start-up to £1 billion or more? Only 56. So wouldn't it be great if we could have more of those? And I passionately want some of those to come out of our Growth Partner investments. We've got a great investment team working really hard, supporting those businesses, finding more deals. So it's really exciting.
Richard, thank you so much for joining us. Don't be a stranger. You have to come back to talk to us about some of the great things you find. Richard Harpin, founder and chairman of Homeserve and Growth Partner. Now, we do have some breaking news out of China. China considering cutting interest rates on as much as $5.3 trillion of mortgages in 2 steps to actually lower borrowing costs for millions of families while mitigating the profit squeeze on the banking system. Now, again, we have been waiting for a long time for some kind of bazooka from policymakers in China to try and support the economy, trying to support some of the industries, including real estate, that have been under pressure. This is just another step. It doesn't feel like the bazooka that maybe certain markets or certain analysts were expecting, but it's another step like what we saw in the last couple of weeks towards a more stable and better market. Nvidia, of course, a big story today. When you look at Nvidia, it was slammed yesterday. unclear. I mean, there are a number of concerns, of course, with the subpoena, the DOJ, and then there's that manufacturing data in the U.S. that also worried investors. For the moment, down 2%, 1.8% to be precise, pre-market. Now, let's talk more about Nvidia and some of the market sell-off with Bloomberg MLIV strategist Ven Ram. Ven, I mean, thank you for joining us. When you look at stocks and the volatility, it kind of blew up again. And again, there are 2-3 reasons why, but not an underlying shift in fundamentals.
Absolutely, Francine. I mean, that speaks to the jittery market, how valuations have run up so much in such a short span of time, but that even without a major reason, that the markets are selling off big time. I mean, if you look at the S&P 500, the earnings yield is 4.3% something. If you look at NASDAQ, it's just about 3.4%. So if you look at those in relation to the Fed funds rate, those are the lowest earnings yield ever in history. So those valuations are very stretched. And if you look at what some of the smart investors have been doing, like Warren Buffett's Berkshire Hathaway, they've been taking money off the table, even of some of the best businesses they hold, Bank of America and Apple. So that speaks to a market where there are plenty of contrarian signals suggesting that, look, this house of deck, this deck of cards can't continue unsustained, and therefore, investors need to sit up and take notice.
So you're also looking, I mean, they'll certainly, getting up and taking notice. You're also looking at the Taylor rule, which links the central bank's interest rate to economic output and inflation. What is it telling you, Ven?
Well, it suggests that the Taylor rule is suggesting that the Fed has got plenty of room to cut rates because the rate is pretty restrictive. It shows that, the Fed can afford to cut rates at least 8 times in this entire cycle. And some of the banks that have the deepest room to cut rates are the Bank of England, surprisingly, and the Reserve Bank of New Zealand. So those have upwards of 250 basis points to cut rates. The ECB, on the other hand, has got room to go only 130 basis points. So the ECB is not going to be able to cut rates as much as the other central banks. That is going to be a positive for the euro.
Ven, thank you so much. As always, Bloomberg MLIV strategist Ven Ram. Coming up, the U.S. charges the leader of Hamas for his involvement in the deadly attacks on Israel last year. We'll give you all of the details next. And this is Bloomberg. Now, the U.S. Justice Department has announced criminal charges against Hamas leader Yahya Sinwar and other militants in connection with the 7th of October attack in Israel. Now, let's bring in Bloomberg's Horizon anchor, Jumana Bersetche. Jumana, tell us more about the charges.
Yeah, that's right. So the Department of Justice unsealed yesterday that it had introduced criminal charges on 6 party officials from Hamas, including the current Hamas leader Yahya Sinwar, in relation to masterminding the October 7 attack. And of course, this is the first time that U.S. law enforcement formally call out the masterminds of this attack. The charges that they included were conspiracy to provide material support to a foreign terrorist organization, conspiracy to murder U.S. nationals, and conspiracy to use weapons of mass destruction resulting in death. Now, the timing is interesting here, Francine, because the charges were initially filed back in February. They were only unsealed yesterday, which raises a lot of questions as to why it took the Department of Justice so long to actually unseal these announcements. And the other thing that is worth noting is that even though 6 party officials were accused of these charges, it is estimated that since then, over the course of the time period between February and now, 3 of them are thought to be dead. And Yahya Sinwar himself is thought to be hiding in tunnels in Gaza, but it may have somewhat of an impact because one of the names, Khalid Mash'al, is currently residing in Doha. And what this means potentially is that it could allow U.S. law enforcement to apply pressure on those seen to be aiding the organization and therefore potentially potentially here it could open the door to the U.S. applying pressure on Qatar when it comes to housing one of these political leaders from the Hamas organization. But in terms of actual impact on the ceasefire discussions, Bloomberg have spoken to officials from the U.S. who have signaled that this shouldn't have an impact on where these discussions are going because, of course, it remains a priority for the Biden administration to get this ceasefire deal over the line.
Jumana, thank you so much. Jumana Bersacha there, Bloomberg's Horizon anchor, joining us this morning. Now, the Ukrainian President Volodymyr Zelensky has restated a call for air defense systems after Russian missiles killed more than 50 people in one of the deadliest strikes since the Kremlin's invasion began more than 2.5 years ago. Now, this comes as a broader government reshuffle takes place in Ukraine. The country's foreign minister, the latest to submit a resignation following 3 cabinet resignations yesterday. And Elon Musk's satellite internet provider Starlink has reversed course and says it will comply with an order by Brazil's top court to block access to X. Now, it comes amid Elon Musk's bitter standoff with the country after a Brazil Supreme Court justice ordered the social media service to be banned as part of a campaign against disinformation. China is one of the biggest sources of finance for African nations, pouring in more than $120 billion of government-backed loans through its Belt and Road Initiative over more than a decade. Let's get straight to Bloomberg's Ondiro Oganga, who's in Kigali for us. Ondiro, China's heavy lending to the continent has been called debt trapping by some. So why is this? And good morning.
Good morning to you, Francine. This is because the volumes that China has been lending to the continent has exponentially grown over the last 2 decades. It went from $98 million in 2000 to about $28 billion in 2016. Of course, because of the COVID-19 pandemic, these lending levels plummeted, but they've begun picking up last year, $4.6 billion. Africans, on the other hand, have high affinity for Chinese money. They've been embarking on mega infrastructural projects, and Chinese money does not come with the same conditionalities as the World Bank and the IMF. The problem is this debt has been accruing, and currently many African countries are in debt distress. Some have even defaulted on their debt, like Zambia, Ghana, and Ethiopia. If you look at Angola, a third of the external debt is owed to China, and this is raising questions on the sustainability of the debt and the volumes that China is lending to Africa.
So how, Ondiro, was that debt accrued, used, and what is the state of those projects?
Majority of this money has gone into infrastructure project. 120 billion has gone into the Belt and Road Initiative, and some of these projects have been successful. For example, power plant projects in Zambia and Zimbabwe. Some have failed to live up to expectations. If you look at Kenya and Nigeria, their railway projects did not live up to the expectations, and hence $5 billion has sunk. Also, China, through these projects, has been able to build influence, and now they have access to energy and also critical minerals. And so this is almost a catch-22 situations. Despite the fact that there are concerns about Africa and the relationship with China, many of their leaders are in China currently for the forum, and that just goes to show you how deep Chinese influence in the continent runs.
Ondiro, thanks so much. Ondiro Oganga in Kigali. Now, coming up, continued disturbances for Cathay Pacific as a lack of engine parts keeps some of its A350 fleet grounded. That's next, and this is Bloomberg. Well, Bloomberg has learned that Cathay Pacific may not be able to pull all of its Airbus A350 aircraft back into service as quickly as hoped due to a spare parts shortage. Now, the carrier has taken several jets out of service in recent days after an engine component failure on one of its A350s. Let's now bring in Benny Kamel, our global aviation editor. Benny, thank you for joining us. So how much disruption has this actually caused for Cathay?
So Cathay is still working through the backlog from this incident, which happened on a flight on Monday. That sort of led to this cascading inspection. We hear from Cathay that about 90 flights had to be cancelled through to the weekend. They hope to have operations back on by then, sort of by the weekend. So most of these are local and regional flights, and very few of them are actually long-distance flights. So that sort of reduces the disruption. And the good news is, in some ways, that the repairs that they've had to undertake on these aircraft are actually fairly short. It's about 90 minutes. You open up the engine, you don't have to take it off. The part that needs switching, it's something that has to do with the fuel supply, is fairly easily accessible. So all of these things point to an issue that can be contained.
So, Benny, has this caused disruption for other airlines as well?
Other airlines are sort of leaning on Cathay and asking for advice. That's what we're hearing. And some of them are inspecting their fleets. Singapore, which is the biggest operator of this particular aircraft, they've undertaken checks. They've found nothing so far as far as we know. Other big operators include Lufthansa, Qatar Airways. So far, nobody else has come forth and said we've found similar issues, which is a bit of a head scratcher, I'll be honest, because you'd think that this is something that goes beyond just Cathay's issues. But so far, nothing. It might be that they have found something and they're quietly fixing it as part of a maintenance cycle. That part we don't know. But so far, publicly, nobody else has come out, so the disruptions are really only on the Cathay side.
So what's the fallout for Rolls-Royce and potentially Airbus?
For Rolls-Royce, we saw the fallout quite brutally on Monday when this first came out. The stock dropped quite dramatically on that day. This is a stock that's really done incredibly well for investors this year and in particular last year. So any piece of bad news sort of disrupts that story. The stock, as I said, down more than 8% on Monday at one point. They have come back because I think investors are looking at this and are saying, okay, this does look like something they can contain. It's a problem, not great, but it's sort of a day-to-day thing that happens, and it seems that they have a handle on it. For Airbus, same thing. If this were like a material issue for their A350 jet, that would be a real issue for them. That doesn't appear to be the case. So overall, it seems that the industry at large has dodged a bullet here, and they can move on from this.
Benny, thank you so much. Benedict Kamel there, Bloomberg's global aviation editor. Up next, a Bloomberg Brief with Danny Berger and Manish Krani in New York. A global flight from risk assets seems to be continuing today, this Wednesday. This is after we had fears yesterday about the U.S. economy and, of course, a retreat from big tech. This is Bloomberg.